Edge designations, CFA Level 1, Pre-Reading Economics, Learning Module 6, International Trade and Capital Flows. This is the 6th economics pre-read out of a total of 7 dealing with international trade and capital flows. As per usual, we can give you all the learning outcome statements on the front page over here for Learning Module 6. There they are, and of course, as we go over the page, you'll see that we repeat each of those learning outcome statements on the front of every page. Let's get ourselves going straight away. Learning Module 6, International Trade and Capital Flows. Not an overly crazily difficult learning module, but some lovely nice information in here that we need to get through. And we begin our discussion with the comparison of gross domestic product, GDP, and gross national product. Okay, a few definitions. GDP measures the market value of all final goods and services produced by the various factors of production, and we define the factors of production as labor and capital, okay, located within a country during whatever particular period. Most times GDP is measured quarterly. GNP is just another way to measure the performance of a country, okay, but we'll see what is the difference there between GNP and GDP. GDP seems to be a bit more of a broader measure, okay. GNP, gross national product, okay, is the total market value of goods and services, okay, regardless of where any of these goods and services and factors of production are residing. Okay, GDP, which is a measure that we like to use, which is more often used, measures the value of output produced within the borders of a country. So GNP is inclusive of everything. GDP just talks about what goes on within the specific borders of a country. So GDP is, if one wanted to go to GNP, you would start off with GDP, add in all the foreign receipts and subtract then the foreign payments. GDP is a more widely used measure, okay, than is GNP. Let's have a look at some of the terminology that we're going to be using throughout this particular learning module. Imports, we know goods and services that a domestic economy purchases from other countries. Exports, goods and services that the domestic economy sells out to other countries. Terms of trade, okay. Terms of trade is an interesting, one would think it's just a nice, easy definition, but what it really means, it's the ratio of the price of exports to the price of imports, apologies. Net exports, the difference between the value of a country's exports and the value of its imports. You often have a trade surplus or deficit. If we are exporting more than we are importing, okay, then we've got a trade surplus. And on the other side, if the value of our imports is greater than the value of our exports, then yes, we're importing more. We've got to pay more for those, and we are receiving from what we export. That'll be a trade deficit. Interesting word called autarky. I'm sure people are familiar with it. And what autarky measures is the state of a country that doesn't trade with any other countries. In other words, and now just keep in mind, if it doesn't trade with any other countries, then everything that is consumed within that country has got to come then from that country, because there is no trade with other countries. Okay. Over our page. Okay. And we're going to talk about two different prices. We're going to talk about an autarkic price, okay, which is the price, okay, of goods and services within the specific country. Doesn't trade with anyone else. It's a fixed price. That's typically called a closed economy, as opposed to an open economy, and that price is called the world price. That's the price where everybody in the world trades with one another, and obviously that price is more of a global price. We call that the world price. Okay. Free trade. What is free trade? When there's no government restrictions on a country's ability to trade. You don't find that often. Obviously, there are certain restrictions and duties and things like that. trade protection, okay, that protect a certain country's imports and exports, things like tariffs, quotas, etc., things like that. We have two specific measures over here, FDI and FPI. FDI stands for foreign direct investment, okay, which is the direct investment by a firm in one country, we call that the source country, in productive assets in a foreign country. Okay, and the minute that a firm makes use of FDI, foreign direct investment, okay, they then become a multinational corporation, obviously operating in more than one country. Okay, what it then is FPI, foreign portfolio investment. That's more of a short-term nature as opposed to investing larger and longer-term assets. Short-term investment by individuals, firms, and institutional investors, okay, in foreign financial instruments, things like stocks and bonds. It's more on the investment side, shorter term as opposed to longer term in productive assets of a country. Okay. No good economics lecture, stroke class, stroke notes would be complete if you didn't have something about supply and demand. And we talk here a little bit about excess demand and excess supply. We talk about the supply and demand curves for cars. Okay, that's the only asset that we are dealing with over here. And if you have a look over here, okay, we start off with the price over here, PA. PA is what we call the autarkic price. Point E is then autarkic equilibrium, and at this particular point, okay, the price is PA and the quantity demanded is QA. Remember, autarkic, that is when everything happens within a specific country. Nothing leaves the borders, nothing comes in, nothing comes out of that particular country. Okay, what if we moved, let's say, to price number 1, and I'm just assuming that this particular, it could go one of two ways. We don't have an exact order, but from autarkic to world price can either go down, or over there, the price can go up. Okay, let's work on the first one, assuming that the price goes down to the world price. Okay, and all of a sudden, okay, what do we notice? Okay, and if you look over here, okay, there's world price, we call that world price P1. Okay, the domestic quantity, okay, is QK, okay, and the amount supplied is QI. Okay, so as you can see, and look what's happened, the price has gone down from the autarkic price, PA, it's gone down to P1, but the challenge is that this particular country at this particular lower price really only has need for a certain amount, and therefore its quantity is sitting over there, but the price is good, so the quantity at this particular price is quite a lot more. What does it do with all the excess that it has? Well, the difference between this point over here is where it produces at price 1 and sells that quantity to the domestic guys, and this point over here when there's a much larger demand, that's called the excess demand. Okay, and because there's an excess demand, that can then be, okay, excess demand, we talk about things like imports. And why is that? And of course that's because the price is, okay, quite low. As we move up to the price over there of P2, okay, look what happens at P2. Now the price is quite a bit higher than it was previously. Look what you've got over here. Now there's a little bit of a difference between those two prices, because what's happened? Okay, not so much required at those higher prices. We've got this concept now called excess supply, and that's what we mentioned over here. The world price is now at P2. Quantity demanded is QC, which is over there. Not so much. Why not so much, guys? Okay, not so much because the price is probably quite high. Okay, and that's QC over there. The quantity supplied is QD. So the local guys don't want so much. The price is a little bit, maybe a little bit rich sitting over here. What does it do? But it is able to produce over there. What does it do with all the excess that it's got? those are exported, as opposed to what did we see over here when the price was sitting there at P1? Well, the people demanded, well, there was a demand for that, okay, but they didn't supply so much. Okay, so where did they get all the extra amounts from? For the excess demand, that came in the form of imports. Okay, I hope everybody can see from this particular picture, okay, the demand and supply basics when we now talk about the different pricing. And you can see very clearly in this picture, okay, as we move up and we move down from what we call the autarkic price, which is over here, okay, as we move up, the price becomes a little bit too high, okay, generally excess supply. As the price goes down there, it becomes too low. Well, there's an excess demand. If the local guys are demanding more, where would we get that from? We'd need to import. Okay, hopefully that makes a lot of sense. Okay, we move on over here. Next page. Okay, describe the benefits and the costs of international trade. Okay, unfortunately, with economics generally, guys, you do find it is a little bit more qualitative as opposed to quantitative in its nature. And yes, there's generally going to be a little bit more in terms of theory. Okay. International trade benefits, you gain from exchange, you gain from specialization, economies of scale. There's a greater variety of products and services available to the households, increased competition, and more efficient allocation of resources. Okay. International trade, there's a certain amount of costs as well, potential for greater income inequality and loss of jobs in developed countries as a result of importing. Because what will happen if you can get a country that can produce this particular item at a cheaper price, well, you'd rather get it from them. You would import from them at the cheaper price, but remember that'll damage local industry and people are likely to lose their jobs. Okay, we now come to what is probably the crux of this entire learning module, where we talk about comparative versus absolute advantage. We'll talk about absolute advantage first, and I'll just read this to you. It's the ability of a nation, okay, to produce, for whatever reason, to produce more of a good than another nation. So both countries, let's just say, for example, and if I just give you an example over here, because we're going to use this as we go through. There's South Africa, and there is Malawi. Okay, each person is making use of one laborer. We're assuming that is the resource that we are looking at. And South Africa can produce 5 items with that one laborer, and Malawi can only produce 2. That would be an absolute advantage. Okay. We come to another concept, guys, called comparative advantage. Comparative advantage is to be able to produce a product, but not absolutely, but with a lower opportunity cost. So now what we're going to look at, and we're going to do this throughout this particular learning modules with the help of examples, is now we're going to look and say, well, hold on, what if I produce 2 products? Yes, both of those products I can produce absolutely at an advantage to my competitor country, but not in terms of comparative or lower opportunity costs. Let's have a look over here. Okay. Applying the concept to international trade. Okay, and we know the concept that certain countries have got different resource endowments. Some are more resource rich, some are more labor rich, some are more tech rich, whatever it happens to be. Okay, and each one should use whatever resources they've got to their absolute advantage. Okay, when we look over here, and we're going to use this example as we go through. Okay, just keep your head about you, because we work with halves and twos and things like that. It does get a little bit complicated. Assuming only 2 countries exist, South Africa and Malawi, and these countries produce wine and they produce fish. Okay, the only resource in each country, okay, is the resource then of labor. Okay, South Africa has got an absolute advantage in producing both products. Why? Because South Africa can produce 5 fish, Malawi produces 2 fish. South Africa can produce, okay, 10 bottles of wine a day, and Malawi can only produce 1 bottle of wine a day. What do you notice? That on an absolute level, okay, South Africa has got advantage in both. But now what we look at, let's say, or maybe in terms of looking at comparative advantages, maybe there'll be something in terms there of opportunity costs. Look over here. Okay. In South Africa, what have we got? We've got a worker, and that worker can either produce 5 fish or 10 bottles of wine. Now, if we had to say to her, well, let's see, what's the cost then of each one? Because let's just assume if he produces 5 fish, no wine, 10 bottles of wine, no fish. So what would that, the mixture then be? Is everybody comfortable? It's been the ratio of 5 fish to 10 bottles of wine. We could refine that and lower that further to 1 fish is equal to, okay, he'll either make us 1 fish or he will make us 2 bottles of wine. Is everybody comfortable with that? And that's obviously what we conclude then over there. Okay, now if I had to say to you guys, and this could well be, if they were asking an exam question on this, they would say to you, what is the opportunity cost of a fish? Well, the opportunity cost of 1 fish is 2 bottles of wine in South Africa. Okay, and obviously if we wanted to reverse that, what is the opportunity cost of producing a bottle of wine? Well, that's the other way around. If it's 1 fish to 2 bottles of wine, it's 2 bottles of wine to 1 fish. And if you wanted to say that, we could say it is going to be 1 bottle of wine. If you produce a bottle of wine, what are you foregoing? Half a fish. Is everybody comfortable? These then are my opportunity costs. Everybody comfortable? Okay. Now let's go and look at it from Malawi's point of view. Malawi can either produce in a day with a worker 2 fish and 1 bottle of wine. Okay, so what is their opportunity cost? Okay, theirs is going to be 2 fish to 1 bottle of wine, or if you wanted to refine that further, 1 fish to half a bottle of wine, and on the reverse side, 1 wine to 2 fish. Okay, can you even see what we're doing over here? We're saying, okay, yes, we understand that South Africa has got absolute advantage over Malawi in terms of the production of fish and wine. But on a relative basis, a comparative basis, and the word I'm looking for is opportunity costs, there they are different. Is everybody comfortable? So Malawi's opportunity cost, 1 fish, half a bottle of wine. South Africa's opportunity cost is 1 fish, 2 bottles of wine. So what do you notice? Okay, that looks a bit better than for Malawi, doesn't it? 1 fish is a half a bottle of wine. Okay, and 1 fish is 2, sorry, other way around. So that's, if you have a look over there, it doesn't look so good in the fish department, but let's have a look then at the 1 bottle of wine costs 2 fish, and for South Africa, 1 bottle of wine costs half a fish. Okay, so can you see over here straight away what are we noticing? Okay, and what would you say? Wine is cheapest to produce in South Africa. Why? It's a half a fish, not a lot. Okay, whereas in Malawi, what would you say? 1 bottle of wine costs 2 fish. It's a lot more expensive, and fish is cheaper to produce in Malawi. Only half a bottle of wine. Okay, South Africa, it should. It takes 2 bottles of wine. Now we can conclude. I'm going to change my color over here. South Africa should produce wine. Okay, why should South Africa produce wine? Only costs half a fish. Malawi should do the fish. Okay, because fish in Malawi only costs half a wine. Is everybody comfortable with that? So what we come at, as I said, you guys, it does play on your mind about the halves and the quarters and which way you've got to go. But is everybody more or less comfortable at this point in time that when we look at this particular picture, you can see that no country has got a complete comparative advantage in both areas. Absolute yes, but not comparative. So now we can see, well, hold on a second. Malawi, okay, you can produce fish quite cheaply, only a half a bottle of wine. Wow, okay. Malawi, you do the fish, and South Africa, okay, you do the wine, okay, because a bottle of wine only costs you half a fish, and on an opportunity cost, a comparative basis, okay, trade will be advantageous, okay, and there we go. Here's another little example for you. I'm not going to spend too much time on this one. It's a new example, okay, just on the law of comparative advantages. And all that it shows you over here, guys, okay, and I'll just do one of them with you. Let's look at country A. Country A, if they produce 0 units of champagne, well, then they can produce 16 units of bread. But what then if they decide, hold on a second, we want to produce champagne and the next available amount is 12 bottles of champagne. Well, if I'm going to make 12 bottles of champagne, how much bread do I lose? Well, I'm now going from 16 units of bread down to 8, so I lose 8 units. Now, if you have a look over here, okay, look what we can deduce. We can say, hold on a second. I now make 12 units of champagne previously, 0. What's my difference over there? I can now make 12 new units of champagne, but I lose 8 units of bread. Everyone happy where I got that from? Okay, that's over there. And there we go. That is my that now becomes my ratio of 1.5. In other words, every time I give up a loaf of bread, okay, I can make 1.5 units then of champagne. And you'll do the same thing then for country B. I'm not going to spend more time on that for you. Okay, I want to hop straight back into our previous example, okay, where we dealt with fish and we dealt with the wine, and we now have this frontier called the production possibilities frontier, the PPF, okay, and that looks at the various combinations and look at the words, guys, production possibilities. Okay, remember my example before, nothing's changed since there, we've kept everything constant. What I'm making the assumption over here, South Africa, let's say it's got 50 million workers, and Malawi 250 million workers. Well, let's go and see if South Africa has got 50 million workers and they can produce 5 fish in a day. Well, if everyone in South Africa was just making fish, they'd make 250 million fishes. I don't know how you make fish, I assume you fish for fish. In terms of South African wine, there are 10 in a day. Each laborer can make 10 bottles of wine. If everybody works and they make 50 million workers, you get 500 million bottles then of wine. On the Malawi side, Malawi can make 2 fish. Okay, and it's going to look at Malawi, 2 fish times 250 million people. There are 500 million fish. If everyone in Malawi decides to make wine, they can each make a bottle of wine. 250 million people, 250 million bottles of wine. And again, straight away, what do you notice? You can see again, look at the differences between the South African. You can see clearly one is much cheaper and easier to produce than the other. Okay, what we do now is we just illustrate the production possibility frontiers. Now, can everybody see why it's called the production possibility frontiers? Because what I'm now doing, I'm saying, well, what can you make? We can make a certain amount of wine, certain amount of fish, and then we say, well, okay, how many workers have you got to be able to do that on a daily basis? And there we go. Okay, let's have a look at the first picture. South Africa's PPF, okay, looks as follows. 250 million fish, but remember, guys, if they're making 250 million fish, no wine, or they can make wine, no fish. Okay, they make wine, 500 million bottles of wine. Okay, let's have a look at Malawi. Malawi can either produce 500 million fish, that's over there, but no wine, or 250 million bottles of wine and no fish. Now you can see that is Malawi's picture there. We're going to talk about why we've got another little picture there next to it. Okay. But remember, it doesn't have to be either or. You can produce a little bit of either, but yes, just remember, if you produce a little bit more or less of the one that you are, that will then impact the other one. Okay. Let's have a look over here and let's just talk about our example here. Okay. And look what Malawi is going to do. Let's just spend some time. We'll just look at this one. What if Malawi decides to go from 500 million fish, okay, and they now decide to go down to 250 million fish. Let's change our color over there. It's over there. Okay. Well, now they're making less fish. Okay, and now you can see what they can do now. They can go and make some more wine. Okay, and you can just see what this does. Okay, to the picture, because remember, as soon as Malawi is not doing one or the other, but instead, what are they doing? They're trading with another country. Okay, then what happens? Their PPF will shift. Okay, let's have a look. Okay, and I just want to read this verbatim because it's just so important, because this goes to the whole point about how we decide to trade. If there's no trade, okay, then the country's consumption will be, okay, as we've shown you over there. Remember, I'm just going to take you back up because we superimposed them one on the other. Can you see over there? South Africa first started off at 250 million and 500 million. Let's put their graph in there as well. Looks similar to that one, which is that graph over there. But what we're trying to show you is how you can shift the graphs, the PPFs, as a result of trade with other players. Let's have a look. Trade expands the... Okay, South Africa decides now, let's say South Africa, listen, I'm going to offer wine to Malawi because it only costs South Africa half a fish. They have got a comparative advantage in that area. Okay. Now, if Malawi offers any more than a half a fish per bottle of wine, then South Africa is going to be better off because that's what it costs them to produce. Okay. Wine in Malawi costs 2 fish per bottle to produce. So Malawi is going to be quite happy to acquire wine at any price less than 2 fish. So you're going to have to agree on a price then between the two different countries. And let's say, for example, we set the price in the middle. Okay, not exactly the middle of a half and 2, and now we say 1 bottle of wine is going to cost a fish. South Africa specializes in wine because it's much cheaper for them, so they use all of their workers. Remember again, guys, South Africa had 50 million workers and they could produce 10 bottles of wine. That's the 500 million bottles. Why do they specialize in that? Well, they decide, okay, hold on a second, that's the best one for them, but they don't make any fish. Okay. Now, South Africa's got the option of drinking all the wine themselves. Not a great idea, I wouldn't think. Okay, or selling some of it. And remember, if they sell some of it, what do they get? They can get some fish. Okay, what's the ratio? 1 to 1. That's why they can get 500 million fish. Okay, it should be clear to us now that South Africa is better off than before. Okay, because what can they do? They produce 500 million bottles of wine, sell 250 million bottles of the wine. Okay, and get 250 million fish. They can now move, and I'm going to show you this on the picture, to point D, which they couldn't get to before. Let's go back and have a look. Okay. They can get now to point D on the graph. Let's change our color. Everyone comes up, why can they get to point D? Because now they can consume 250 million fish, and they can have wine as well. Everybody comfortable with that? Okay. Whereas beforehand, for their 250 million fish, they got no wine, but now you can see the value of comparative trade. And look what that does to their particular PPF. It shoots the PPF out then to the right-hand side, as does that do the same thing then for Malawi, because Malawi also now is in a better position as a result of their trade, and there we go. Okay, so it's just important to notice, and that's what we're trying to take out of those particular graphs, is those graphs can shift outward as a result of positive trade among various countries. What is positive trade? Is that you decide that the particular country, okay, that has got a comparative advantage, they produce those items and they trade them with another country who has got a comparative advantage in their area. Okay, we move on a little bit over here. The implications of the law of comparative advantage. Okay, comparative advantage will result in the expansion of total output. We're going to get more out overall. It will also result in mutual gains for each trading partner if each partner specializes in that which they can produce at a relatively lower cost. Okay, and based on that, what would we conclude? For trade purposes, comparative advantage is key, not absolute advantage. Okay. Some real-world considerations regarding comparative advantages and gains from trade. Okay. Importing goods from a country with a lower production cost. Okay. Just keep in mind there are transportation costs, and at the end of the day it might work out to be more costly when you take into account transportation costs. Okay. In cases where marginal costs of production increase as we increase our output, your PPF, okay, your frontier, your production frontier, okay, would be more convex as opposed to linear. Okay, you may still gain from trade, okay, but you won't get what we call complete specialization. For example, had we looked at that graph, and that particular graph then was completely linear. Other sources of gain: market size, okay, particularly relevant for small countries. International trade, yes, it may expand their market, but remember they can only produce a certain amount, being a small-sized country, okay, and just keep that one in mind. Okay, competition, top of page 10. International trade forces, okay, the domestic producers to compete because, okay, consumers will benefit from the competition, the pricing, and as well as the additional choice of product. Okay, the export-import link. Okay, important to note, exports are necessary to earn foreign exchange, and when that foreign exchange is earned, we use that foreign exchange that we have earned in order then to pay for the imports. Okay, we now come to two separate models. Okay, let's have a look. Okay, explain the Ricardian and Heckscher-Ohlin models of trade, and let's have a look at their sources of advantage from each particular model. Start off with the Ricardian model. Ricardian says that where does your comparative advantage come from? Okay, just differences in technology between the various countries. Okay, and who's ever got the better technological know-how in that particular area, that's what they should then be producing. That will be their competitive advantage. The Ricardian model makes certain assumptions, okay, as do most economic models, guys. Okay, labor is the only variable factor of production. Differences in labor productivity, what are they? If we're only considering one factor, what's it due to then? Technology. A country with a lower opportunity cost in the production of goodwill will then specialize in its production. In a two-country model, okay, you might find the smaller country is completely specialized, but it doesn't help them so much because they're too small and they're unable to meet the total demand, because the total demand comes from much bigger countries. Okay, and that might then leave the larger country being incompletely specialized, okay, because they can't make full advantage of their comparative advantage. Came along the Heckscher-Ohlin model, okay, and it's a slight alternative to the Ricardian. Okay, it says that we look at all the factor endowments. What are all the factor endowments? Well, now we're going to include not just technology, but capital and labor in there as well as factors of production. Okay, and in order to try and work out where my comparative advantage is. Technology in an industry is the same across countries, but might well vary between industries. Now we look at things like capital to labor ratio. Okay, when there's capital abundancy, there's a whole batch of capital, they are more likely to specialize in capital intensive goods. Okay, when that rate, a country that is relatively labor abundant will go more for labor intensive goods. Okay. Over our page, top of page 11, we're going to talk now about the balance of payments. Okay, let's have a quick look. Balance of payments is really, and look at the words, guys, balance of payments. It's a double entry bookkeeping system that summarizes transactions of a country, citizens, the businesses, the governments, with foreigners. It summarizes information relating to exports, imports, earnings of domestic residents that is located abroad, earnings on domestic assets owned by foreigners, international capital movements, and official transactions by central banks and governments. We've got a few examples for you down there. Okay, what is important is that the balance of payments is divided up into three separate components: current account, capital account, we'll talk about that, and then the financial account. And they got a balance. So what we're going to notice is that if one of them is in deficit, and we'll talk about why is it in deficit, the other one then will be in surplus. Okay. We talk now about current account transactions. The purpose of the current account is to keep a record of all transactions with foreign nations that include what? Exchange of goods and services, okay, current income derived from investments, as well as unilateral gifts. So we've got, first and foremost, and this is the biggest one, merchandise trade transactions. The export and import of merchandise goods is the biggest component of my balance of payments. We've also got service exports and imports, okay, things like insurance, transportation, and other services as well. Okay, we've got income from investments, okay, for example, income of Americans from their investments abroad, okay, will supply foreign currency to the forex market, okay, and it'll be a credit on the current account. Okay, unilateral transfers, things like monetary gifts to foreigners, okay, these will be debit items in the balance of payments. Okay, now we can summarize all of that, and we have a look at the balance on my current account, okay, and that'll take into account all of my factors that we've just spoken about over there. Okay, and just to summarize, when the value of the current account debit items is greater than the credit items, we've got a current account deficit. Remember, if there's a deficit on the one, there will be a surplus then on the other. Okay, let's have a look over here. Next one, we talk about capital account transactions. Okay, these deal with changes in ownership of real and financial assets. So you can see the word capital account. We break them down into two major sub-accounts: capital transfers, okay, and sales and purchases of non-produced, non-financial assets. What's like a non-financial assets? Rights to natural resources, intangible assets, patents, copyrights, things like that. Okay, over our page. And the last one is the financial account, which can be broken down into two sub-accounts: financial assets abroad and foreign owned assets. Financial assets abroad, okay, into official, we break this down into official reserve assets, government assets, and private assets. What are some of these assets? Gold, foreign currencies, foreign securities, things like that. Foreign owned assets, okay, we divide these into official assets and other foreign assets, okay, include things like securities issued by the reporting country's government and private sectors. Direct investment will be included there as well, and foreign liabilities there as well. When we look now at the balance of payments, look over here. So in other words, what's it got to do? It's got to balance. Balance means equals comes down to zero. So my current account balance plus my capital account balance plus my official reserve account, as you can see, unless all of them are exactly the same, which unlikely that they will be, okay, in terms of surplus and deficit, some will be, that's in a surplus, capital will be in deficit, and so it will work. Okay, let's have a look up. We've given a couple of examples over here. Let's just work with one. Commercial exports. Let's look at this example. Okay, a company in South Africa sells technology equipment to a Chinese auto manufacturer. The total price is 50 million rand, but that includes freight of R1 million. This merchandise will be shipped via a South African cargo ship. Okay, now what's important over here, just to illustrate the point, is that we break that down into two: equipment, which is the 49 million, and transportation services, which will be the million. Okay, South Africa would record 50 million debit to private short-term claims. Okay, a credit of 49 million to goods and 1 million to services, just to show you the point over there, how we split up then between merchandise and services. Nothing too crazy there. And we've given you a couple examples, so I'm not going to go through each and every one of those then with you. But there are a whole batch of them there. Just example after example, just to illustrate how we break down the balance of payments. What we do now, okay, is a real economic pleasure. Okay, it's what we do. We work with equations and we make one equal the other. Okay, and we come up with some insightful information from that. Okay. We look over here, national economic accounts and the balance of payments. And we're going to start off with a closed economy. So the closed economy says that Y, which is all my output. Now remember, in a closed economy, if that's your output, that'll also equal into your GDP, okay, is either consumed or invested by the private sector. That's C, private consumption, okay, investment, or government purchases of goods and services. So it can only go to one of three places, but it's all kept within the system, and Y is all your output. But remember, because it's a closed system, okay, there we go, it's all going to come from GDP. Let's go. Okay, so, and we start off with our very first equation over here. Our first equation says Y, okay, and Y is also equal to GDP. For a closed economy is equal to C. Okay, there's my consumption, investment, and government. So it can only go to various sources, and all of those sources are contained then within the economy. What if we move from a closed to an open economy? Now look what happens. What happens with an open economy? So my Y, or all of my output, or all of my GDP is now equal to, well, exactly what it was equal to before. It can go anywhere there, but where else can it go? Now we can start to trade imports and exports. Okay. There we go. Net exports is the difference between X and M. X is exports, M is being imports. How does this relate a little bit then, guys, to our current account? If I'm importing, bringing things into my country more than I'm sending out in terms of my exports, well, I've got a current account deficit. If my X, if I'm exporting, I'm sending more and more out than what I'm bringing in, we've got a current account surplus. So what do we see? Okay, so on the right-hand side of my equation, a current account surplus or deficit has also got an impact then on GDP. And how does that work? Remember, Y is my total output, which also was called GDP. Okay, is everyone comfortable with that? Okay. This requirement means that a country with a current account deficit, now Y's got a deficit because M is great, it's importing too much, okay, must start to increase its foreign debt by the amount of that current account deficit. Okay, and let's say look at an example. If a country has a current account deficit for many, many years, okay, as it accumulates foreign liability, well, remember, because it's called the balance of payments, it's got to finance it somehow. How does it finance it? By net capital imports, loaned by banks, sale of their own equities, etc. So you can see the current account and the capital account will somehow have to balance each other out. Okay. And on the reverse side, okay, if the country's got a current account surplus, okay. Let's rearrange that second equation that we had before, and now we're going to define the current account balance in terms of national income. Now what have I got? Well, there's my Y. Remember what my Y is what? My Y is my total output, or GDP. And where does that go to? Consumption, investment, or government. And it's also equal to X minus M. What's X minus M? Because X minus M is imports and exports. And what do we say? Only by borrowing money from foreigners can you have a current account deficit. Because otherwise, where would you get? Remember, the accounts have to balance. So if you've got a current account deficit, well, you're getting that money from foreigners. Okay. And then you can consume more than you produce. Okay. But remember, those are borrowings. Okay. Top of page 16. If the country consumes less than it produces, got a current account surplus, and then it can lend the surplus to foreigners. Okay, let's have a look over here. That's called a surplus. Now let's have a look at the relationship between normal output and a bit of disposable income. Okay. Of course, guys, T always is important. T is your taxes. Okay. The private sector receives net. Okay. Disposable income, that's YD, is equal to what? The total amount that I'm able to produce. Is everyone comfortable with that? Plus R, whatever transfers we have, less, of course, what I've got to pay out in terms of taxes. So what do we say? Disposable income is allocated to what? Consumption and saving. So what could you say? YD, which is my disposable income, okay, is equal to C, consumption, and private sector saving. What if I now decided to merge those two equations? Okay, because they're both YD, aren't they? What do I get? C, consumption, is equal to YD less SP. YD is my disposable income less my savings, which is also equal to Y, which is my output, plus money in and out, less taxes, less private savings. Okay, we can go further. You can see I warned you we're going to be playing with the equations just a touch. Let's go for number 7. Okay, we can use the right side of equation 6 to substitute for C back in equation 3. Let's have a look what that gives me. CA is my current account. SP, private sector saving, less investment, plus tax, government spending, and movements in accounts, the R. Okay, T minus G minus R is government savings. Okay, because that's what the tax, T is what they get in for taxes, G is what government spends less R. Now we can say SP plus SG, private savings and government savings, is equal to I, investment, plus CA. CA is, okay, my current account. What do we notice now from equation number 8? The big difference between open and closed economies. An open economy, okay, can use its savings for domestic investment or foreign investment. Okay, a closed economy can only be used for domestic because, remember, it does not deal with other countries. Okay, equation 8 shows us we can raise investment by increasing foreign borrowing. What will that do? It'll reduce your current account without having to increase domestic savings. Okay, and let's have a quick look, and it's a nice example, too nice to pass up on. For example, if Thailand decides to build a network of high-speed trains, look what it can do if it's an open economy. It can import all the materials, let's say from Norway, but it doesn't have money to pay for them, so it can borrow money also from Norway to pay for the materials. Now, what does this do? It increases Thailand's domestic investment, okay, because what's going to happen now? Okay, they're going to use the imported materials to expand the country. Okay, everyone comfortable with that? Okay, and keeping it all else being equal, it'll also produce a current account deficit for Thailand by the amount of the investment. Okay, but what do you notice? Their savings don't have to increase even though the investment increases. Okay, and that's called an intertemporal trade. Thailand imports their present consumption, okay, and it borrows money to fund that, okay, but then once it's done that and now it's invested in itself and now it's got goods and services, well, now they can export that, okay, when it repays the loan. Okay. Number 9. Don't worry, there's not too much more to go in terms of our playing with these equations. SP, here's my savings, is equal to, okay, that an economy's private savings, how can it be used? For I, investment in domestic capital, CA, purchase of assets from foreigners, less G, okay, net purchases, or could even be redemptions of government debt. Last but not least, if I bring equation 8 back into the picture, what do we say? CA, the current account deficit, okay, or current account is SP, private savings, plus government, less investment. So now we can see how the whole thing talks to each other. Okay, a current account deficit results from low private savings, so not much money going on, but a lot of investment, okay, a government deficit, or could be a combination of any of those. That's why there's not much money going, is there? A current account surplus is there's a lot of savings going on from private individuals and not so much money being spent. Low private investment or a government surplus. Okay. And what do we say? Trade deficits often result from a lack of private or government savings, okay, or booming investments. And we can see those are any of those three that we mentioned earlier. If a trade deficit reflects strong investments, the deficit country can just increase its productive resources, and by doing that and starts to produce more and more, they are able to repay their liabilities. Okay, what do we see from equation 3? That a current account deficit often reflects a strong domestic economy because there's a lot of spending on. Well, that's what caused the deficit, but yes, there's a lot of spending going on in the economy. That's often accompanied by increased domestic credit demand and high interest rates. Okay, the thing is, in such an environment, okay, where you've got much higher interest rates relative to other countries, okay, that can lead to net capital imports and produce an appreciating currency. In the long term, however, the problem that you've got, if you've got a constant current account deficit, okay, leads to a permanent increase in the claims held by other countries against your country, the deficit country, and foreign investors may require certain premiums in order to for these claims, and yes, that unfortunately will lead to a depreciating currency. Okay, that then leads us to a conclusion of learning module 6, international trade and capital flows. Top of page 18, we've got a little bit of a summary for you over there, 18 and 19. And as we do normally, we always require of you, please, to go back to the beginning of the particular learning module, back to page number 1. Do take a look again at the learning outcome statements contained on the front page over here, and just read through those and make sure that you are able to understand them. And if you read through them, yes, that makes sense. I've seen that in the particular learning module. I understand it and I'm good with it. Well, then you've done your job. If not, maybe recommend it to go through this 1 or 2 more times. That brings us to a conclusion of learning module 6, learning module 7 coming up.